Hello everyone, this is Professor Kent. Today's recording is to cover some of the questions that we learned, theory that we learned in chapter 5. And this one, what we're doing is we needed to find out what class this asset is sitting. First of all, the asset has to be a differentiable property in order for us to put them in a class. When we put them in a class, that class has a percentage that we write off as a CCA. My first one is taxi cab, and that goes under class 16. We have a reference books that are replaced every 10 or 5 years. They will go under the 8. This one is if the then the next one is periodicals and other books replaced every year. If they're replaced every year, they will not be a capital property. They will not be capital expenditure. If they're not capital expenditure, we just expense it. If we expense it, there's no class for them. We have a manufacturing processing equipment purchased acquired in 2024. They will go under the 53. You have a franchise that with a limited life. If it's a limited life, is 14. If it's an unlimited life, it will be 14.1. So then we have an automobile that it will be your 10.1. We have a government license that is unlimited. If it's an unlimited life, that is 14.1. Storage tank will be 6. Photocopier is 8, and then leasehold improvement is 13. We have a residential rental property that was acquired. In that we have a building and land does not depreciate. We cannot put land anywhere. For the building, it will be 1. So land does not depreciate. If it doesn't depreciate, there is no class for that. Now we're going to go to exercise 5.3. We have a mistake. We want to know, did we take out too much CCA or we didn't take any CCA? So we needed to know what we're doing with it, which class they are, in order to find out the percentage. During the taxation year ending December 31st, 2024, your company purchased a depreciable property for 326,000. That's what they purchased it. They go under a class 1, and the class, if it's a class 1, they go under 30%. So we are under the 30% CCA. So that's what class 10. So this goes under the, oh, hold on, they made a mistake. I have it, hold on. So they're saying during the taxation year December 31st, the company acquired a depreciable property for 326, and you of course incorrectly included in class. So what we did is we put it in a class 1, but we shouldn't put it in a class 1. Class 1 is a 4%. We should put them in a class 10, and class 10 has a CCA of 30%. So what we did is we made a mistake. So if we made a mistake, we needed to fix the mistake. So we needed to know what the correct CCA is going to be. The correct CCA should be 326,000. We are going to have a 30% CCA, and then it is your 100% of that CCA will be written off, because anything that is purchased after the 2024, that is a ACC, is accelerated investment, and then we're allowed to take 100% of the CCA. So that will be the correct amount should be 97800. And what did we actually claim? So what did we actually claimed? So 326,000, we said that it's on class 10, and the CCA we take is 30%, and 30%, 4%. We 4%, and then it's an accelerated, so that'll be 100%, which is one that will be accelerated. This stands for accelerated investment, and that will be 13,040. So this is what we claimed, and this what we should have. This should be that much, CCA should be that much, and that's what how much we claimed. So the difference between the both numbers is 84760. So what we have is we have an understatement of our CCA. We understated our CCA. We should have taken a deduction and we didn't do that. Let's go to the next one and see what the next question is asking us to do. So now, of course, we have a CCA and it is an accelerated investment. So it qualify for accelerated investment. We want to know how to do that. So if you do it in a way to make your life a little bit easier, so put it in the date. So it's saying company has Redmore Limited with the taxation year ends on December 31st, has a class 10, the CCA on that class is 30%. UCC, so my beginning balance is undepreciated capital cost that we started off with is 950,000. So that's what the UCC we started off with. What we do is if we acquire it, we're going to make an adjustment, and how much is the adjustment. So I'm just waiting for my pen to come back. So I will have to add is my any acquisition that we have, any purchases we have is an acquisition. So what they said is it acquires 15. So what we did is we acquired 15 what automobiles. The cost of each is $20,000. So we acquired what? We acquired some of my automobile. How many we acquired? 15 of them. The cost of each one is 20,000. So that's, come on, so 20,000, and then my purchases, that's my addition. So my acquisition during the year is 300,000. So what we do is we purchase it and we sell it. So when you add the purchases and we deduct our disposition. So we deduct our disposition, and let's see what the disposition is. So we deduct the disposition, means disposal. That's another way of saying it. Dispositions are called a disposal. They told us the company also disposed 18 automobile for the amount of 144,000. So they told us the cost of those 18 of them. So we call it net addition. So my net addition will be 156,000. So that's my net addition. And what we do is we add any accelerated investment. So in this case we have it nil. So this gives me a CCA base that I can take my CCA for the year of 2025. We want to know what my CCA should be that we claim, and what will be the balance that we will be starting at January 1st, 2025. That's what we're going to do. So we needed a depreciation for the year 2024. So when you have a base, this is the base that we're going to take our CCA. You take the 950,000, add your 156,000, and I will get 1,106,000 in my CCA base. And this is my base, and we could also say that is the UCC when it is on December 31st, 2024. I needed to claim my CCA for the 2024. How am I going to do that? I'm going to take 1,106,000, that's my base, multiply by my CCA rate, and that is 30%, and that's the CCA that I'm allowed to take in this year. And then what we have is here we add and here we subtract our ACC and accelerated investment, and we call this as a reversal. So that's a reversal. If I didn't add anything, I'm not going to be subtracting anything, so this will also be nil. So what happens is then I have something called January 1st, 2025. My UCC balance will be 774 200. So that's what you will be starting with. The January 1st, you will be starting with a balance. And what is that balance? 774. It is my 774 200. So that's the balance. So how did we get it? You started with 1,106,000 minus the 331,800. I will get a balance, and my balance, that is 774. I think sometimes I write too fast and my computer can't take it, and then that's when the pen goes. So it will be your 774 200. So that's the balance, that's the amount, should be 7724. Seven seven four 200. So let's go to the next one. What is the next one telling you? We have some additions. We want to know how to deal with those additions there, and we don't want to know first what class they are and what the addition is. So it's a class 13. We're in class 13. So when you have a class 13 in Watchcon Limited has a December 31st tax year end. The company leases its office space under a lease that was signed on January 1st, 2019. The term of the lease is 10 years with an option to renew and increase the lease for 5 more years. We're only allowed one renewal. So we are only allowed one renewal. So in 2024, at the beginning of 2019, so what happened on the beginning of 2019? Let's say we have a 2019, that was my leasehold improvement. We're going to say leasehold improvement. The cost of that leasehold improvement was 52,000. This is a limited liability, and we have 10 years was the life. We are allowed one renewal. We divide it by 5, and that will tell me what my CCA will be on the lease that was acquired or signed on the 2019. So that will be your 3467. On 2024, what happened is the changes were required to the lease, and what happened to the lease, they spent another 31,000. So this was in 2024. It was so what we're going to do is we're allowed to write off 100% of it. So how do we do that? My 2024 improvement, the cost of those improvement was 31,000. We divided this, the life is 10, and we're gonna write off 100% of that. So 100% of that is your 3,100. And the CCA, the maximum CCA that we can take for the maximum in the year 2024, maximum will be 6567. So that's how much is going to be. Now sometimes we are allowed, if I were to do that, there's another way of doing this calculation if you wanted to do that, but let's do the 24 and then we do the 25. When you do the 25, this is year 24, the same thing apply. In 2019, we have 52,000 divided by the 15, and the CCA that we can take is 3467. And the 2024, the cost of the leasehold improvement, the cost of the lease was 31,000 divided by 10, and that is 31,065.67. So you will be taking the same CCA if nothing else changes in the in your class. So let's go to our next one. What is my next one telling us to do? Let's erase it because I needed to erase this. So let's see. We have next, what we have is class accelerated application for class number 14. So we're dealing with class number 14. While they said they're similar, class 13 and 14 are similar in the sense of straight line method. The only difference is this I wanted to say, class 14 is not subject to half a rule, so they're not subject to half a rule. But class, however, will have a benefit of 50% of the accelerated adjustment based on the additional to the class for the qualifying property. So this one is, we want to know if we could what we could do with the question that is given to us. So let's see if I could figure out what's happening with this question. So on December 31st, the company's tax share is December 31st, by 31st year end. On what we did is we purchased something. When did we purchase it? We purchased on April 1st. If that's the case, we need to count how long we had the asset in our books. So first, what we call in accounting, we call it capital cost. Under taxes, what we call it acquisition cost. Acquisition cost, and the cost of the acquisition is 375,000, and we purchased in 2024, and we purchased on April. Our year end is December 31st, and there's 275 days that we are going to be depreciating the asset. Now when you're depreciating the asset, what happens is that we are allowed to take the 100%, and the cost of this asset was, the franchise was 375,000, and it's a limited life. If it's a limited life, I divide it by 10. What do I get? I get a CCA. This is my CCA, and CCA is 28,253, and CCA is minus, and that will be your January 1st, 2025 UCC you start off with, and you take another CCA. You carry on doing what you're doing from till it becomes you sell it or becomes a zero. Let's go to our next one. My next one will be, what are they asking you? We're looking at class 53, and again in 24, and then what did we do? We started off a UCC balance, and the balance that we started off on January 1st, 2024, the balance we started off with UCC was 500,000. This property has a capital cost, so the accounting terms are capital cost. So but we call it acquisition costs under the income tax. That's what we call them. So under tax, we call them acquisition costs. Under the accounting, we call it a capital cost. There is in 2024 with a capital cost of 100,000. So that is my acquisition. Acquisition is additions, and what we did is we purchased 100,000 worth of property in this class. There's no disposition. Determine the maximum CCA. So what we're going to do is, in this case, 50%. So this is where the 50% is coming again, the 50%. So my accelerated investment adjustment will be, for the adjustment will be half of the acquisition. So only half of the acquisition. In this case, my acquisition here will be 50,000. 50,000 is, take the 100,000 multiply by the 50. If you add it here, you have to do a reversal too. So this is only for the CCA base, and if I add all the numbers, that will be 650,000. We are in class 53. Under class 53, we will be allowed to take a 50% CCA. So my CCA rate here is 50% of your 650,000, and that will give me 325,000. So that will be the CCA that I'm allowed to deduct. Now, in order for me to start the next year, we have to do a reversal of your accelerated investment. So accelerated investment adjustment reversal. So we make the adjustment and we take it out. So this is the reversal. The reversal is only what we put it in. That's the only thing we could take it out, and that gives us the ending balance or beginning of the next year UCC balance, and that balance will be 275,000, and we carry on doing what we're doing. So now accelerated only applies to the year that we purchase the asset. So the year we purchase the asset. So we're going to go to our next one. Our next one is explaining the taxation year for short fiscal year. If we have a short fiscal year, and we needed to do one is if the being the taxpayer and one as being the business. So how is going to be the impact? So first we do the business perspective, and then we'll do it from the individual perspective. So let's see what's happening with the question. So before we go, so I started off with what we began our operation. When did we begin our operation? On August 1st 2024. On September 1st we started we purchased something, and it is a class 8, and the year end is December 31st. So we needed to count how many days are gone by from the when we started the business. So it's a short year, so you have to count, and it comes out to be 153 out of the 153 days out of the full year. My full year has 365 days. We have a capital cost allowance. We have a capital cost of the additions. That is your 115,000, and that is my acquisition costs of that is my acquisition costs. So then what we have is that's my base. When you do that, we are in class 8. Class 8 has a CCA of 20%. If this is my cost, that becomes my base, and the CCA that I will take will be 115,000 multiplied by the 20%, but we have a shorter year, 153 divided by 365. So 150 divided by 365, it will give me a CCA. I'm trying to work it out, the CCA. My CCA, that will be the CCA that will work it out. I got a 9641, and it could be that I made a mistake too, but I was just trying to rework it out on my phone. So it will be 9641. So I'm just going to wait till my pen comes back. So 9641. It's the internet is so slow in here. So that will be 96. I'm just going to do it here. 9641. That's the CCA I would take. CCA is a deduction. You take the cost minus your CCA that you've taken, and that becomes the base of your. I'm doing it with my finger. So that is my base for the following year. That will be 105. 359. So that will be 105 359. So if it's a taxpayer, so for the so if this asset was purchased by the individual, this one was with the one we just did is with the carrying a business as if the other one is if you're not carrying a business, you will be an individual. If you're going to be an individual, there is no partial year when you have an individual. We do it for the if it was a taxpayer, if it's an individual. So the cost Cost of the asset is going to be staying. I'm going to write it with my finger till it comes back. The cost of the asset will be the same amount, 115,000. And the only difference is when you're taking a CCA, there's no partial year, so this part is gone. So you're going to take 115,000, multiply by the 20%, and my CCA that you will take is 23,000. The UCC that you will start, or the base of your falling year, will be difference between those two is your 92,000. So this will be my 92,000. However, the base is different if it's a business. Base is different if it is a if it is individual. So the second 92,000 will be my UCC that I will start off with. My CCA is more under the individual than the business, because a business we needed to worry about. What we need to worry about is the year, the short period of your corporation is makes it different. So now the next thing we learned about is a capital gain. So we have a capital gain. When we think of a capital gain, we think of a perspective of accounting, and when it's a recapture or terminal loss, we think of from the income tax point of view. We have that. Let's look at it. First one, it says on January 1st, the current year, Hussein Limited has a class A. Their balance was UCC, so they had a balance of you started off with a balance which was 275. They're not talking about CCA. All they're talking about is what happens if you sell an asset. If you have sell an asset, you needed to see what's happening. So if you have a asset, and then what we are doing is we are we sold, either you buy it or you sell it. If you sold it, it will be less. When you're doing a less, will be, when we look at the less, the cost was 18,000 and we sold it for 23,000. When we do that, lower of the cost and disposition. So we take the lower amount when you sell it. In this case, it'll be 18,000, and then that will be your CCA base. The difference between the both numbers, my phone just died, so difference between those two numbers, and that will be your, I'm just going to do 0 0 0 7 5 257. And what I'm going to do is I'm going to multiply by my class. My class is the CCA class. This is in, which is a 20%. So I take the 20%, which will be your 51,400. So that's the CCA we'll take. Difference between those two becomes my UCC that I'm starting with the following year. Now we have two things here. First, we're allowed to take a CCA of 51,000. However, since this asset still continuing, if the asset is still continuing, there is no recapture or terminal loss at this point. Now, but we call it capital gain. And how do we get a capital gain? Capital gain will be your 18,000 was my cost. We sold it for 23,000. We sold it. This is my cost. Difference between the both number is your 5,000. And what we're doing it, this is my capital gain. In income tax, we pay taxes on the 50%. 2,500 becomes my taxable capital gain. So taxable capital gain, I needed to include it to my income, so I pay taxes on that. Now we have I'm only going to do recapture and terminal loss. I'm only going to do recapture and terminal loss. I'm going to do 12 and 13. So I'm going to do 12 and 13 just to show you how do we know if it's a recapture or a terminal loss. That's the one we are going to be doing, is a recapture or a terminal loss. Oh, no, I have to do recapture first before I can do a terminal loss. So we have a recapture here. So what happens in this case, we have on January 1st, Patel Inc. has two properties, class 8, the capital class of each 27, and the UCC that we started off with that. So what we have is first my UCC balance, and that balance is on January 1st, 2024. The balance we started off with 24,883. Now what we have is we have to add, if we purchase it we have to add, and we call it acquisitions. In this case we don't have any acquisitions, are zero, but then we have a less is what we disposition. So disposition is what we sold position. When you look at it, you look at the lesser of both capital costs and proceeds. So proceeds are proceeds of disposition. So in this case what they said is the cost of the asset that you're selling was 27,000, proceeds was 28,500, lower amount is 27,000, and when I do that I have to do 27,000 here. Do that and deduct any adjustments, and deduct any accelerated investment reduction, and that we don't have any. If we don't have any, we're not going to have any recovery. This will give you your CCA base, or the balance. Since we sold all the asset in this pool, you have to sell all the asset in the pool in order to have a recapture or terminal loss. They said there is no other additions or disposition in the year. So this was the last asset in there. So how do we what do we do in this case? We will have a negative number. If it's a negative number, in order to, so what we have is, this is the UCC balance on December 31st, 2024. If I needed to add it to bring this balance to be zero, so if it's a plus, we call that a recapture. If you have to minus it, it will be a terminal loss. Recapture, you have to add it here in order to make this class as zero balance. So recapture will be added to the business income. Recapture is added to the business income, and we pay taxes on business income. At this point, we also have one more thing. Difference between those two is my capital gain, and we pay taxes on half of it. Difference between those, and I multiply by the 50% to get my taxable capital gain. So I will also have a taxable capital gain, and how much tax capital gain, how much will be that? The cost of the asset was 27,000, and we proceeds of disposition that we sold was 28,500, and what we have is we have a gain, and then we multiply that by half, and this gain is 1,500 multiplied by half, 750, and that becomes my taxable capital gain. So my gain is 15, my taxable capital gain is 750. I need to add this to the income, and we into the business income, and we also have to add the recapture into the business income. They both are going to be added to my business income. If you have a terminal loss is if the asset has a positive number, then you will have a terminal loss. It has to be the last asset in the pool in order to have a terminal loss. It says at the beginning of 2020 period have two properties. I think it's a similar question. One has a positive and one with a negative. I shouldn't have raised it. The UCC we started off with 24,883. We don't have any additions, so we leave the additions. Or we call it acquisition. In our case, acquisition was zero, less my disposal. When you think of disposition, we take a lesser of what the cost and disposition. So in this case, the cost did not change. No, it did change. So we sold it for 9. The cost was so the cost was 27. What is the cost? Hold on. What did they tell us? So it's in this case the question is changed to two properties. So we sold two properties. So the cost was 18,000, which was okay. The cost was 18,000, and the sold. The sold was 18,000. The cost was 27. You can multiply by two because there's two properties. So the cost will be this position is 18,000, cost will be 54,000. How did I get it? The cost of each property was 27,000. We have two of them, that's how we got it. Disposition, we sold each property for 9,000 each, for each, and there's two properties. The lesser of the both is my 18,000, and that becomes your becomes your UCC balance, and this balance could be a negative balance or it could be a positive balance. I have 6883. In order for me to close this asset, I needed to minus it. If you're minusing it, what do we have? We call it a terminal loss. Terminal loss will reduce your business income. It will reduce your business income. So that's the terminal loss we have. It will reduce your business income. And I'm going to be finished here. We showed you how to do CCA. We showed you how to calculate capital gain. We showed you how to do taxable capital gain. We showed you how to do a short year and some of the CCA. So you can do more questions at the back of the chapter. If you have any questions, please don't forget to reply under the send a message under the YouTube this video, so that I can reply to those questions. Thank you so much for listening to me. Take care and bye for now.